is trading day, the close.
Well, it's all over. The end of the financial year hits home and the market today rallies some 1.8%, but reflections on the month that was, falling some 2 3/4%, and for the financial year itself, the first loss clocked inside 3 years. To get to grips with what comes next, my guest for this hour, Tony Farnham from Patterson Securities, and joined on set by Pete McGuire from XM.com. Warm welcome to you, Pete. Lots to mull. An impression just on a day like today, and we're going to get into the commodities story shortly, but just squaring off positions and surprisingly...
Yeah, had a very nice uptick. I mean, over the last 48 hours, it's been very strong. You saw what happened in New York. Seen strong markets in Asia today. I was quite astounded. 2 o'clock this morning, I mean, the way US was going, it was one-way traffic, very, very solid. I think the Nasdaq was nearly up 2%. So it had a very, very strong, I suppose, component leading into our day, and that's been reflected with pricing. You've seen crude, you've seen gold, you've seen all of the markets all looking fairly strong.
And yet another naysayer on this market, and a bigger story at play, actually, the economy on housing. Hedgay, who is a analyst, well, that's the House, but Josh Steiner there, a presentation saying we're in a bubble, over construction, waning demand. Has he got a point? Or is this just a broken record story on shorting the banks?
Well, I would have thought that the Perth and the parts of the NT, parts of the Queensland areas that are aligned with mining, they've already done a lot of their correction already. In terms of the apartment space, no doubt there's overbuilding. That's self-evident. So my concern there, and what I've been watching, is no massive drop-off in overseas interest in that line. But in terms of the Australian space, housing, Sydney and Melbourne, that's where the employment is.
Construction.
And a house in a well-located area, near schools, near water, etc., is going to have an underpinning of a price, even with a recession.
Even with a recession?
Yes.
And so also these comparisons with the Canadian market, it's tempting that they go down this route and say, you know, there are similarities, therefore we'll make extrapolations and arrive at a conclusion. Do you see that as altogether, though, you know, not comparing apples with apples?
No, I think not. I mean, look, we've got a very, very strong population growth. Where, you know, it's as far as certainly we're underperforming, you know, from a construction side, going back over the last 10 to 20 years. There hasn't been simply quite enough properties. And now we're getting plenty coming online, and over the next couple of years there's certainly going to be some, you know, very large developments that'll actually hit the market. I think there's an appetite out there, dependent upon overseas and what happens as far as the Asia situation and China, but I think that it'll be absorbed to the market.
And don't forget there's a tax treatment story as well in terms of the castle, and the castle is tax-free. And
at present.
At present.
There's a nice segue there from the castle to by royal appointment. It's our next guest, who happens to share the name with one top royal, no less. Sensio Engineering, my next guest, taking the reins of this company, reprivatising it through a management buyout. We're here today to delve a little bit more deeply into it and come out with some projections on investability or not as a result. What next for this engineering and building consultancy firm? Well, CEO Kate Middleton is live in our Sydney CBD studio. Warm welcome into the programme.
Thank you very much.
Let's sort of go back to basics on this. Walk us through the business. What are you doing day in, day out? What do we mean when we talk about insurance adjusting and engineering?
Yeah, sure. Okay, so Sensio's been in the market for over 10 years, and our core business is structural and civil engineering assessments on residential and commercial property. So a really great recent example would be the awful storms that we had along the eastern seaboard when some of those lovely homes in Clovelly fell into the ocean. Then a big insurer would appoint an insurance engineer to go and have a look at the home or the commercial property and assess whether or not that's an insurable risk. So that really is the core business. And then from that, we'd provide an engineering report that would form part of the overall claims acceptance decision for a large insurer or a bank who provides insurance.
So is this work that you do, is this in concert with what local councils do, or do you work? Are you potentially outsourcing the work that they do at the moment as well?
Oh, absolutely. Councils are a core part of our business. So most of the councils along the eastern seaboard are actually underwritten by Echelon and JLT. So we do quite a bit of work with them in collaboration with councils such as Randwick City Council. And it really is about being that impartial third party who's able to go and estimate the loss and then report back to the council or the insurer or the bank or whoever the private investor might be to provide some sort of insight into what is insurable and what is not, and what falls within PDS provisions and what would be deemed in insurance terms an act of God.
Before you took the reins here, you were consulting to the parent company, which listed Sensio alongside itself, Stream, SGO, the ticker code. What was the reason for that spin-off in the first place? What was hoped to be achieved and what went wrong?
Yeah, look, that's a really good question. Sensio's had an interesting history. It was a really great profitable private firm, and then a few years ago was bought out by Cerno, who were listed, who were then subsequently bought out by Stream, and we now know that unfortunately one of the spin-off companies of Stream Group Limited, which was Stream Group Australia, did suffer quite a catastrophic liquidation late last year, which did, create some losses for some of the large insurers. Sensio of its own right has always been an independent business, but needless to say, just through osmosis and its association with the Stream Group, it has suffered some client attrition over the last 12 to 18 months. So really the goal of the management buyout from the investor's perspective, the global secure creditor, is to separate out what is a profitable, isolated business from a now defunct parent business. And from my perspective, I'm just really keen to ring fence a company that's had a really great track record. We've still got great insurance customers. We've got a really stable team and a 10-year track record of profit. So it made sense to execute a management buyout after I'd consulted into the company, because obviously from investment terms, when you are conducting a management buyout, you really do have the advantage of having been immersed in the day-to-day of the company. So you really do understand how to execute strategy within that business, as opposed to just investing in a startup or a greenfield project.
So in terms of your revenue stream, is it lumpy? Like, do you get a lot more work after a significant act of God and so we better check this in terms of where we're at, or is it a constant flow of work in your business?
A bit of both. You've raised a really good point. Obviously, as an insurance supplier, there is a lot of seasonality. So, when you do see those big storms, you do get an influx. But there is quite a lot of business as usual work. Some of the most common causes for an engineer to need to attend a home are things like, incomplete house maintenance, land subsidence, cracks in pools. So it really is a testament to the fact that maintaining upkeep on what is most of Australia's biggest investment, their home, is really important, because it can prevent you from having an uninsurable event in your home outside of just those acts of God.
Kate, do you feel as though that you could move this business into Asia and expand the footprint that you've currently got?
Look, that'd be great. To be honest, I don't know enough about the Asian insurance market to comment in terms of how their products are structured. But when I look at the Australian market and the barriers to entry, engineering's quite unique in that when you look at the kind of in-house and then outsourced models that insurers and banks apply, there are only so many portions of the value chain that can be outsourced. So in answering your question, there's no reason why we couldn't expand into New Zealand or Asia. The reason being, it's very difficult to actually re-indoctrinate an EPCM-based engineering company to be able to provide engineering-specific services. So as long as you've got a great team and they have an understanding of PDS coverage and whatever those caveats are across different borders, then certainly there's no limitation in that. I guess it would come down to compliance and all those nitty-gritties.
Because I'm just wondering, to Pete's point, what what questions on that were being asked by the global venture capital firm Nisa Capital that you've got now an association with? Presumably, they have very much that same kind of motive in mind longer term as well.
Expand the business.
Yeah, expand the business. So are they not asking you those questions about how portable is this? What synergies could we apply to something in Asia?
Yeah, look, that is a good question, and I'm really fortunate to be aligned with such a large global VC firm because, as you guys know, typically private equity and venture capital don't even play with an investment that has anything less than 10 million net profit per year. So I feel like it was as much an investment in me and my local capability as it was the company itself. I have plans for expansion within Australia, but learning from lessons learnt, there has been quite an unfortunate track record of liquidations with the loss adjusting market in Australia. You look at McLaren's, who are a global firm who had a defunct business and have now successfully re-entered. They partnered with MYO Freemans, who then became Cerno, who then became Stream. There is some danger in trying to push for exponential scale within that marketplace. There are some core capabilities that need to be improved upon within the Australian market before you can even consider expanding into Asia. And some of those things are really aligning your value proposition with what insurers and banks require from a great supplier. Things like having a great online digital value proposition, client centricity, low operating costs, which can be on-sold onto the insurer. So my real goal is to bed down one of those great business models in Australia before we even consider partnering, JVing, acquiring or expanding into another country.
And your core team, what's the skill set? Who are you constantly on the lookout for? What's the profile?
Excellent question. So we do operate within an ageing market. So most people who enter loss adjusting or engineering within the insurance field have already done site-based or big project roles. So they're looking for something that's a little bit more local. I'm really on the lookout for graduates. I want to build a new breed of assessors who understand and leverage technology. They understand client centricity. They're still deeply technically capable, but they also understand how insurers work, and that for that period of the claim, they're an extension of the client's experience and we're custodians of the big insurer and bank's brand for that point in time.
Best of success. No easy task even getting the right fit on that measure, but
an exciting industry, risk management all over it.
Yeah, thank you.
You said it. Thank you for joining us.
Thank you so much.
Kate Middleton. What a name, CEO there of, well, you heard it there, Stream.
But you can see it adaptive to, aviation, healthcare services, what's going on with mining, all forms along those different industries that, risk is such a big part of their business model. So, yeah, I think that there's certainly upside for something like that.
Growth is the thematic is the thing that I'd be looking at. You can work the existing skill set harder, but as the lady was talking about, she was saying that we're going to have to get more on board and we want graduates, but that's a mentoring process that for a time
want some old heads as well.
Drags down the productivity.
Yeah.
You got a sense as well that the industry generally is in a bit of not a state of disarray, but not exactly punching above its weight. No. She's reluctant to plough on and saying, look, we've got to first understand, what the customer's wanting here.
Degree of precision to that sort of industry. You can't cut corners, I wouldn't have thought.
No. When you've got insurance.
Is it something that, people can grab hold of and invest in, or is this just too left field, realistically?
Oh, I don't know. I think there's certainly scope for it. And, when you have natural disasters or and you're working hand in hand with insurance companies, there'd be no shortage of work, from shoddy workmanship all the way through to structural problems they have with construction. You fly over Sydney or Melbourne, there's a lot of buildings and there's a lot of problems, and I just look at it to grow the business model across Asia, more and more people, more and more housing, New Zealand, of course.
And climate change.
Yeah, exactly. And then, natural disasters, feeding it all into it.
Because when you've got that downtime, though, you're potentially... what are you doing?
We can imagine Christchurch.
Yeah.
Use that as a business case and have a look at what, all forms of catastrophe, and that would be really at the top end of it. And, a company like hers, I'm sure, would play well into that.
Yeah, good point. Okay, let's take a move away from all of that when we come back. The commodity story, as understood by our next guest from the West. Peter Strachan's along for the ride, talking gold, silver, plenty more besides. Stay with us. Some interesting moves on the Australian dollar. Has fallen half a US cent to 73.81. Reports on Reuters of China's willingness to let the yuan weaken. So we're sitting at a level of 73.79, and that's, of course, going sub 74, which it had been through the session today. Interesting to see how that's just going to potentially develop as a story now. Panel, you've got a view on this one, and we're days out from an RBA decision. That's probably a welcome development. But on the other side of the ledger, this PBOC report, if it's right, I mean, this is the spectre of what's more currency wars.
Well, they're still linked to the US dollar to some extent. So if the US dollar does go up, and of course it did for a period of time in the midst of all the uncertainty around Brexit, it doesn't want that to be occurring because it impacts what's still important for it, its external sector.
And this is all coming as we are awaiting an avalanche of Chinese data.
Yep.
As always, are you looking at the manufacturing piece or more now services? I mean, which is which?
Well, I think you've got to look at both, but if you look at the infrastructure spend over the last 6 months, it's been very, very solid. It's up year on year. You can't take those numbers away. It's about 19.5% versus about 17.8% for 2015. So they haven't backed off in any fashion or form. They're really, pedal to the metal. They've bought cheaply, and they're just employing those resources all the way through. You've just got to say that's their way of stimulating and keeping the engine going, and China's certainly living up to it.
But the more important thing, of course, with that infrastructure is it's useful infrastructure.
Yes.
That's the next thing.
Not bridges to nowhere.
Yeah, that's right. That's a classic example.
Well, it's keeping iron ore comfortably above 50 US a tonne. Peter Strachan from Strachan Corporate is in the West. Let's check in and have a chat with him now. And Peter, welcome to the programme. On that very theme, it would seem that from what Peter's said and what you've got Tony agreeing on now, that there seems to be the right reasons underpinning the current pricing on iron ore. Are you confident in that, or are you still saying we're a bit at sea over just exactly what's being bought for fundamental use, what's being speculated on? Where is the market position?
Well, I mean, I think the market is, what I've been saying is that the market's behaving as if the iron ore price is going to stay at sort of $50 to $55 a tonne. However, the overall supply and demand equation still would suggest that sort of $45 a tonne is likely during the second half of this year.
Is there a further seasonality that we should be expecting in terms of the price from here?
The seasonality is normally that the Chinese would be buying in December ahead of their winter because there might be disruptions to their supply pipelines through January, February and March, and because of our wet season and the cyclone season. And normally then they would be resupplying in May and June. So that's done and dusted. So there's no real cyclical element through June, July and August.
How is it playing into what you're seeing as well on things like the Baltic Dry? Are you basically seeing numbers that are consistent with stability on price through that shipping channel route?
Well, I haven't looked at the Baltic Dry Index for a number of weeks, I have to say, but I know it has been pretty weak. But that index is a function of the supply of shipping and the use of that shipping in bulk commodities, and not just iron ore. It can be wheat or aluminium or wood chips or whatever. And I know there was a big increase in the supply of shipping, and that was the major factor in pushing the Baltic Dry Index down, along with weaker, but I mean still continuing strong shipments of iron ore going out from Port Hedland and Karratha. So there's no reason that with commodities still being shipped around the world, that the Baltic Dry Index should be as low as it is, except if it were not for the additional supply of shipping in the market.
Exactly.
So all the market types studiously look at their Bloomberg each day and look at rebar prices, look at iron ore futures prices and metals bulletin prices on iron ore. Are they a fair reflection of the demand and supply dynamics out there?
Look, I think, I could be accused of it as well, but I think a lot of people are just so focused on the noise, they're not actually seeing the signal. And, look at it day by day, it's crazy. I mean, really, we saw with the Brexit thing how volatility came into the market. You've got machines trading with machines, you've got the algo trading, you've got the high-frequency trading going on. It's hard to know on a minute-by-minute, day-to-day, or even week-to-week. You have to look at a longer-term stretch on these supply-demand issues, and it's hard to turn these things around. It's like trying to turn the Titanic around, it takes a long time for these things to work through. I mean, the high-cost iron ore is still in China, and who knows what's going on with those mines.
Yeah.
Let's go into the precious metals and developments with silver trumping gold now.
Yeah.
How are you explaining that one? How are you understanding that? We can put up a chart to even talk to it.
Yeah, well, I mean, I think if we look back 12 months, then it was silver that was outperforming on the way down, because silver and gold were both falling, and silver fell to around about $15 an ounce as gold was falling. And now as gold has been rising, it's been silver that's actually outperformed, and it's come, it was $18.40 or something, I think, this morning I saw. So it's actually up quite strongly in the last couple of months, really.
Do you find that perplexing, just given the whole growth profile, the Brexit pullback in UK growth prospects? Globally, there seems to be this lower for longer belief on rates even. There's no push to say growth will surprise to the upside. And yet silver's got that industrial commodity overlay to it.
Yeah, not as much as it used to. I mean, silver's the poor man's gold, really. I mean, and because gold has gone up so strongly, people think, oh, well, gold is $1,300 an ounce. I can buy how many ounces of silver for that? So I think a lot of people think it's like, punters, they go for options or cheaper shares, thinking that there's more leverage there when, they're just unaware of the fact of what the supply and demand is. So it's just I think it's just a leverage, or it's a liquidity issue, for the punter.
Yeah. So you're saying that we have sector rotation, we have precious metals rotation as well?
Yeah, we have, and what we've really seen today was that the gold price taken a bit of a breather, and in Australian dollar terms, it's come down about $80, $60, $70 an ounce. It's got to 1,830, 40, 50, on a day, back to 1,760 odd today. So a bit of a breather there, even though there's some good news coming through from companies like Northern Star. And we've seen some pretty couple of, since the Brexit announcement, we've had some very strong moves in nickel, up to $4.30, $4.40 a pound. Still a miserable price, but a long way better than $3.75. Copper seeming to find some support at that $2 level, now to $2.20. Lead and zinc also stronger. So I think there's been people looking at the Sandfires and the independence groups and some of these other companies. Western areas were stronger today on that stronger nickel price.
On zinc, there are reports, Bloomberg's carrying reports of technical resistance at around just above the 11.5-month high, which we're not far off. You've got, though, the dynamic of mines that are going offline for whatever reason globally.
Running out of ore.
How possible will it be to smash through that technical resistance, just simply based on a supply deficit?
Yeah, well, I think what I did in stock analysis this week was to look at the metal markets over a 5-year period, and also look at the inventories on the London Metal Exchange. Now, London Metal Exchange inventories are only part of the picture, because you have to look at the stock that's actually at the mines and the stock that's in the hands of the consumers. So, but it gives you a picture, and I think in the zinc area we're now down to much lower inventories than we saw 5 years ago, so that should be very supportive of the price rise. And I would have thought that the price could slash through. I mean, I think $2,400 US dollars a tonne is something we're going to see later this year.
Absolutely.
It's currently 2,060, 2,070 or something.
Yeah, there's plenty of talk there, Peter. I mean, you know, they may take that $2,500 handle out. I wouldn't be surprised over the next, say, 6 to 8 months. We all know what the situation's been as far as the mining is with the zinc and so on. I think that'll probably wash over to a couple of those other metals as well, and I think generally it'll pick it up. Copper could be a 5,500 tonne trade in the next, say, 3 to 4 months. I think that solid infrastructure and solid push from China is only going to benefit a lot of those particular producers.
Yeah, copper's an interesting one because it's failed to really fall much below the marginal cost of production. It did get down to sort of $1.90s, you know, $1.95, but at $2.20, basically everyone is making money.
Yep.
Inventories are quite low on the London Metal Exchange, so that also supports it, but it's the Dr. Copper. Copper is used in everything, transport goods, construction, and you know, following that is nickel. Nickel inventories are still very high. I think 800,000 tonnes. I think that has to come down to below 200,000 tonnes before we see any really secular moves upwards. Maybe I'm wrong. I hope I'm wrong because I own some independence group and, you know, I'm banking on them making big profits on nickel.
We'll hope they make plenty of pots and pans for us.
Well, it's, you know, stainless steel. Yeah, it's construction, isn't it? And you know, and transport goods.
Well, keep your powder dry because I want to tap you on alumina as well when we come back. We'll take a short break, keep this going with Peter Strachan in the West and my panel, Tony Farnham and Pete McGuire, back after the short break. Continuing our discussion, commodities-related one with Peter Strachan from Strachan Corporate in Perth and my panel, Pete McGuire and Tony Farnham. Peter Strachan, to you, on copper, some factors that might just be raising the question mark over supply issues now, proving a thorn in the side, but then therefore supportive of price. Georgia, a plant there, a key plant, exploding. Where are we at on a timeline to sort out whether that's going to, you know, open again? So far, that's quite a key installation taken out, is it not?
I haven't. I'm not up to speed with that one at all. I haven't seen any news on that.
Tony, your thoughts?
The more adding to that, obviously, we from time to time we get these mines shut up for one reason or another, and facilities shut up as well. But the issue for me is we've got BHP relying on copper as being one of the planks that's driving its business. Got Vale there, of course, as well. What are these guys doing new supply-wise over the next 12 months or so?
Yeah, well, that's an issue, isn't it? I mean, what they've been doing is expanding their mines in South America, but every year the grade of copper that they mine gets lower and lower, and so over the next 20 years we're going to need to mine as much copper as has been mined since sort of 6000 BC, you know, since the beginning of the Bronze Age. So it's just a lot of copper that needs to come out of the ground, and it's becoming more and more costly to get it out. So the average cost of production has risen from like 80 cents a pound to more like, you know, $1.20, $1.40 a pound.
Sounds a little bit like crude oil when you think of it in those sort of numbers,
Absolutely.
Pete. And, you know, and this is the great dilemma for all of the commodity sector. It's becoming more expensive to extract it from the Earth's crust, deeper into the oceans. I suppose the only cheaper one is, you know, your genetically modified grains and so on, but that's from the food side. But base metals are only going to be trickier to remove, and of course the cost is only going to make it more expensive as years roll on.
These are finite, non-renewable resources, and we are extracting them, and most of them don't get recycled. I think 20% of the copper that we use is recycled, about 55% of the lead that we use is recycled, but you don't recycle zinc so much, and
exactly.
You know, of course, oil, you just burn it.
Yep, so true.
So in terms of the metals, at what stage do you get excited by the scrap-related guys again?
Yeah, well, I think that is important, and certainly in the area of lead, it's hard to look at lead and look at the inventories on the London Metal Exchange because there's always a lot of lead just sitting there nearby in batteries. So, and that can respond very quickly. If the lead price was to jump 20% tomorrow, I can tell you that over the next 2 weeks, you just get a lot of lead coming out of those scrappies into the smelters, and that would just flood the market with lead metal. So that's an issue in the lead market, but certainly in and it is in nickel as well, because nickel, the steels are recycled and you're getting the nickel back again to some extent. But that's very costly. I mean, you need $6.50 a pound to really support that sort of supply of nickel. And today we've got, $4.30, $4.40 a pound.
What strategy are you preferring right now on a compare and contrast Rio v BHP, big exploration spends committed by both? This is in preference to an M&A play. And their rationale is, and this is still on copper, their rationale is, well, there are a few targets that meet, that fit our criteria or are even on the block to be purchased. Are they right?
Look, Rio and BHP have both had some really badly bloodied noses and have really flushed a lot of shareholders' money down the toilet over the last decade in these M&A activities. And when you look at the quality of their projects and the exploration teams that they have, you'd wonder why they wouldn't spend a fraction of that money and actually go out and find and develop these new ore bodies, which I think is a sensible thing to do. And what Rio Tinto had a fantastic graph in their exploration presentation that they put out last week, and it just shows that spending on exploration has fallen back globally to around about $5 billion a year in real terms in 2015 dollars, which is about its long-term average. And over the last decade or so, because of the China boom, that had tripled, to about $15 billion a year. But what's more interesting is that over the last 6 years, the amount of discoveries, the amount of significant new discoveries has been falling every year and is now at record lows. So despite the fact that they're pushing all this extra dollars out, looking for new discoveries of base metals, they're finding fewer and fewer. And it's back to our argument before the break, where we're basically saying these things are being more difficult to find, and when we do find them, they're deeper, lower grade, and more dirty and more expensive to mine. So I think the only way for commodity prices is up, and I think that we're going to be, in 2018, we're going to see significant shortages, potentially in copper, but certainly in zinc, not so much in nickel, I think, but there will be shortages, and we will be seeing much higher prices in those commodities in a 12 or 18 months time frame.
Absolutely, Peter. I mean, when you look at the electricity consumption moving forward over the next 12 to 14 years, it's just monstrous numbers. Have a look at where you think crude oil and the energy consumption. So, yeah, that's going to be coupled, and it's just going to sweep up, I think, the commodity cycle. It's having a bit of a breather, certainly, but they're long, protracted growth periods, and they can run for 22, 25, 30 years. And I think that it'll come back. It'll be a long, long cycle, and we'll be still talking about it in 2030.
Well, we've got 80 million new people arriving on the planet every year.
There you go.
That's the global population growth rate, and they want to all plug their toasters in, and they all want to drive cars, and they all want refrigerators. So,
you bet.
Yeah.
So you're thematic there about getting less bang for buck for exploration, and you're talking about shortages. Doesn't it make the M&A imperative for these larger guys, for some of the smaller and mid-cap companies are out there, more important from a medium-term strategy perspective?
Yeah, I think a lot of the smarter larger companies have a fairly lean and mean and really specialised exploration team. And what they tend to do is they go out and then do exploration joint ventures with smaller companies who are lean and mean and on the ground. These are the guys who have their senior people actually out in the ground drilling holes, whereas all the senior people at Rio Tinto are, driving a desk back somewhere, and they're not really using those skills. So I think they could be doing that more efficiently, and that way they can have a much broader approach to the exploration game by looking at all of these other smaller companies that they can do partnership with.
Let's just go into the oil story if we can briefly, because noticing on Reuters crossing now a call out on Iran's July oil exports, saying that they should fall to about 2.14 million barrels a day. That's from a 4.5-year high of 2.31 mil in June. But that figure, even though it's set to fall, is still 70% higher than a year ago. So
the sanctions were lifted.
This is it. So so that's the anniversary, is it?
Yep.
That's the figure?
I
Well,
think it was around about the start of July.
Yeah, that's right. So sanctions started to be lifted in like September quarter of last year. The production has gone up by over 600,000 barrels of oil per day, which is perhaps more than I thought it would. But the thing is, what's this showing is how long can they keep on going? Because all of that equipment is old, it's falling to pieces, and you can run it for a little while, and then things start to fall off, and they get problems with the equipment. So, I suspect that they will reach a sort of a plateau before they have to spend some seriously big bucks to actually sustain production at over 3 million barrels of oil a day. It just won't happen in the short term. In the meantime, you've got Nigeria, production falling there. You've had the hiatus in production coming out of Canada because of the wildfires there, and that's not going away. And Venezuela's effectively going down the toilet. So, there's people like eating dogs, and, it's not a very good situation in Venezuela at the moment. So I think, the oil oversupply that we saw from 2014 to late 2015 is basically gone, and we're now going to see a much tighter supply-demand situation. And as I've said before many times on this show, production out of the light tight oil areas in Texas and the United States generally, that's falling by about 120,000 barrels of oil a day per month. So that's going to continue. Even if they bring more rigs back in, it's not going to slow that declining production. And we're going to see the United States production down by about 800,000 barrels of oil a day by the end of the year.
At what point oil prices at 50, 55, whatever, what's that magic point that gets some of those rigs that were partially complete and the ones that were there already fired up again in the US?
Well, they're starting to do it now. We're starting. I mean, the big falls that we've had in the number of drilling rigs in operation in North America have passed, and we've started to see a few rigs starting to trickle back. But the logistics of actually getting these rigs back into the field is quite daunting. You have to, a lot of these rigs will need maintenance. You have to find the crews again. They might have got other jobs. You have to retrain them. So, I think they can maybe get 10 or maybe 15 new rigs back out into the field a month. But, they would have to get 30 rigs back into the field a month for 8 months just to get a number of rigs back out there to even stop the decline in production. So I just don't think that's going to happen. So,
well, it probably won't happen at $50 a barrel, Pete, but it may happen if it got to 60 or 70. That may start things off a little quicker.
And a final
65, I think, is the magic number.
Final call out. There were healthy rallies in that sector today in energy. Your preferred play, just as a reminder to people, would be what? Go down the food chain, go outside the top tier. Who are you liking as a sort of an upcoming?
Well, AWE, they've had some really good news out of the Andy Lamut project, which they're in joint venture 50-50 with Santos. They've had a good flow from a lower zone in the mineralisation, so they've got about 101 million barrels of oil in that field, but underneath it there's about another 36 million barrels which they're now going to be able to bring into reserves, and there's additional exploration within that field. So that's a field that won't be in production until like 2018, 2019, but they've also got this big discovery in the Perth Basin. It's gas at the Waitsia, conventional gas. And I like those. They're well funded. They've got net cash in the bank. They've got access to additional debt. They'll probably end up buying Origin's interest in that Waitsia gas field. They've got a lot of growth potential. I still like Woodside. They've got a good balance sheet, and they're not going crazy on the M&A front. So I think that's good.
Well, it sounds like you applaud them for knocking back the private equity bid by Lone Star back in May. In hindsight, that looks like a good move if you're pointing to firmer prospects ahead. Yeah, that was
80 cents.
Talking about opportunistic.
Absolute.
Yeah.
Try on. Yeah,
all right.
Yeah.
Peter, thank you for that extended chat. Appreciate it.
Pleasure.
Strachan from Strachan Corporate in the West. Panel back here in Business HQ is returning on the other side of this break. We'll get some final comments in just a tick. Stay with us. Welcome back into the show. A reminder, the market today finished the financial year with a bang, although on reflection, it totted all up and the numbers reversing course. First time we've clocked a loss in just on 3 years. But you put the dividend story into the mix and franking credits, you actually come out just slightly ahead, is the sneaking suspicion. Let's get the views, though, on what comes next. And we have with us to do just that the panellists Pete McGuire and Tony Farnham. You've got a lot of expectations now around the China story. We were talking about the commodity piece just before. Japan as well, and the yen. I mean, just talk to the yen for a minute.
9.3% up for the last quarter, 17% for the year. I mean, they're just monstrous numbers, aren't they? When you think about it, and the way it's going, there's every chance you're going to see even further push up. The dollar, I think, is going through a state of... well, it's a week-by-week proposition. What happens to it 1 week? 2 weeks ago, there was every chance we weren't going to see a rate rise. The dollar was coming off. Then we saw it getting rallied. You know, what happened over the last last Friday, Monday and Tuesday with the Brexit situation. What happens if there's further problems as far as the pound, and where do we go as far as the internal engines of the UK, Labor and the Conservatives? And then what happens if you roll that across to the Eurozone? We've got talks now as far as what happens Merkel, France, Spain, Italy, Denmark and Austria, and Portugal, of course. So,
well, it's a saving grace that at least the pound is free from the shackles of a common currency straitjacket. And so this is actually going to be a net positive.
It was a great call. It was a great call, the politicians doing that in years gone by. And the ones that are still around will be looking at that and saying, boy, we made a good call on that one, and look at those other guys tied up in the euro and some of the mess that's been there. But in terms of what's happening in currency markets at the moment, it's a demonstration. The currencies are not reflecting what's happening in Main Street. It's what's happening in Wall Street and other financial markets. And that's the big disconnect in our markets at this particular point in time. And it'll continue to be exacerbated as long as we have negative rates and the talk by market types wanting sugar fixes for even more of the same.
Janet Yellen's even voiced the possibility and the legality, more to be precise, and kind of put a tick alongside that as an option, not to say she'll exercise it, but you even think going into that line of conversation is helpful or a hindrance, given the experience of Japan?
How do you... I mean, I think there are just so many other conditions in the mix. Certainly you worry about what's going on leading up to the US. We're only about 5 or 6 months out or 4 months out from getting some form of idea, who's going to be the front runner. Yeah. It's too hard to call at the present. And then I'm worried about what happens as far as that euro. That really is it's a minefield over this European summer. And I think that there's a lot of things to play out over July and August, and I think we're going to see an uptick as far as volatility. The markets, currencies have been very quiet over the last 12 to 36 hours, and I think that things will warm up again very shortly.
10 years' time, people are going to look back and say negative interest rates were such a dumb idea. Yep. And I think you'll find this being reinforced over the next little while. And for the US to not take any opportunity that comes its way to at least partially normalise monetary policy is silliness in the extreme on their behalf. So what we've got at the moment, we can't do it now because of Brexit. Oh, we now can't do it because of elections. Yeah. Hello, last night we had personal spending income numbers from May. They were quite okay. Yeah. We've had other numbers that have been quite okay. They're not shooting the lights out growth-wise, but growth is there nonetheless. And they do get some benefit from a strong currency. Again, we get the bad story. Oh, the manufacturing sector's feeling the pain. Well, it wasn't that long ago that I remember buying US-made toolkits, and that's because the US dollar had gone so low. This is a normal process, and that's the way currency alignments and pricing parity theory and all these other theorems of economics work.
The intriguing thing as well about Britain's likely exit, though, is that inflation looks as if it's going to overshoot the 2% target earlier than expected now. I mean, is that rather a perverse outcome? And if so, what are the options for the governor there? I mean, you'd be wanting to raise rates, if anything. in that environment not certainly be comfortable.
Well, again, economics-wise, it's not perverse in terms of what's happened to currency movements, and also more recently what's happened in commodity markets. Prices have gone up, and again, there is a modicum of growth there. So some companies, at least, have had the ability to increase their margins. Not all by any means, but yeah, and that's the problem when you do this focus on financial markets and forget about Main Street.
Of course, and look, that's the whole agenda, what Japan's trying to achieve. Higher inflation, they're trying to get to that 1.5 to 2% sort of headline number, and it may just happen, but it's... How do you compete with negative interest rates? It keeps on getting back to that point. You know, you've got the Germanys, and we know just the situation with the euro. Yeah, it's a mixed bag at the moment.
How does he compete, Kuroda, though, also with that fair trade that sees it as that safe harbour with the greenback? It's like any type of move independent is cancelled out.
Sure.
With a rush back into...
Well, you've seen the Nikkei down, I think, around about 6% for the year to date, so that's not strong. But again, it gets back to that value of the yen, and I think they've just got to keep a close eye on that, because that certainly constricts their market and makes it tougher for the Japanese.
And this move by the PBOC signalling more depreciation, do we welcome that? That it's hopefully letting the market price a fair value level and not certainly, artificially keeping it one hand tied behind the other.
It's the Chinese chapter in the Currency Wars book, and each of the other countries have their own chapter in that book, and the Chinese at this stage still have a currency that's to some extent aligned with movements in the US dollar. US dollar goes higher, they go higher with it. They don't want that to be the case when parts of their economy are showing a degree of growth softness.
And you're optimistic about these numbers dropping any day now, the manufacturing, the services, Kaishin, the private and the state numbers?
So the services number of China are the ones that I try and watch, but it's harder to get a handle on it.
Yep.
Best investment inside the next week, what are you looking at?
I said to you the other day, short crude, and it worked, and it was at 48.50, I think, and it went down to about 46. It's certainly back up to that 48, and this all happens within a matter of 2 or 3 days. I reckon gold. Right. I think there's further upside. I wouldn't be surprised to take a 13.40, 13.45 over the next week. Now, that's where I'm thinking.
The gold bug himself, Pete Speaks. Thank you so much. XM.com CEO Pete McGuire. Thank you, Tony Farnham from Commodities. With us, indeed, Tony, into the next little show with Pete, Peter Switzer. So many Peters today. He's in the chair as well with us. Do stay with us.